However, Stephanie Link, does anything about this rally hang in the balance today with this Fed decision? We think we know what the decision is going to be. We're not necessarily sure we know what comes after that, though.
No, I mean, look, I think we're all expecting a hawkish pause, right? And I think the inflation numbers from yesterday and today really give me confidence, give all of us confidence that they are going to pause. How hawkish are they going to be? That's
you mean
the biggest
hawkish
question.
pause is they pause now, but then they signal they may go in July.
They may go in July or hint. I think no matter what, they're going to talk about being data dependent. So we're all going to continue to be data dependent. So we're not going to really have answers about July.
But if they leave us believing that it was a hawkish pause, does that upset the rally?
No, I don't think so, because I think that's what we're pricing in right now. So if they're even a little bit more dovish, I think the market can go to the upside. And I think what's interesting, Scott, we've been talking about the broadening of the market, right, for the last couple of weeks. It's not healthy to have 10 companies, 10 stocks account for 90% of the returns year to date. So the broadening is very positive. Why are we seeing a broadening? It's a couple of things. We got through the debt ceiling. We got through the bank crisis. We now are getting through inflation. Inflation is not perfect. It's still high. The Fed's still going to be focusing on that, but it's coming down quite substantially, and that is good news. And so as we kind of get through some of these things and we check mark these things, I think that's the reason why people are willing to look outside. And it's not just cyclicals. It's not technology versus cyclicals. It's like technology can cooperate and continue to do well, but it could be also other parts of growth that can participate, right? Could also be small caps. It could be international, which is what we're seeing. So I think that's more healthy, and I hope it will continue.
Joe?
So I think the most challenged position to have, in particular after today's Fed meeting, is those that bought money market funds. I think if you are sitting in a money market fund after today, you have a real problem, because how are you now going to time your way back into the market? The Federal Reserve, for the better part of the last year, was behind. They were basically jogging when the market was running, the bond market was running. So therefore, they had to sprint. And it's reflected in the real Fed funds rate. Look at the real Fed funds rate, which is the Fed funds rate minus the inflation rate. This is now the second consecutive month that's in positive territory. 1 year ago, that was minus 600 basis points. So the Federal Reserve, they didn't have to go from jog to a run. They had to go from a jog to a sprint. So even if they were to raise 25 basis points at some point in the future, I don't see that as problematic for the recovery that we have had.
Yeah, why do you think people are going to pull their money out of money market funds if we get a hawkish pause? Why would they do that? I don't see that at all.
Because those, first of all, if you're sitting in a money market fund, relative to equities, you're massively underperforming. Now on the other side of that is fixed income. If we've seen the high for yields, if you have peak yields, peak monetary policy, what will happen is credit conditions will improve, the soft landings coming back into play, high yield and investment grade, you're ultimately going to get a better return, and those money market yields are going to begin to deteriorate as we move forward.
Yeah, but not if, Kari, the Fed makes you think that they're going to keep rates where they are for a long time. They may be done hiking. Yeah. That doesn't mean they're cutting. They may be sitting.
Right, exactly. And that would, we expect that's what's going to happen. And I don't think the Fed is going to be particularly hawkish. And I believe that the rally does depend somewhat on the tone of hawkishness versus dovishness that we hear from the Fed. Because if we notice what's happened over the last month, we've seen some broadening of the market. Look at small caps. There's a chart we put together. It shows that small caps are up more than the S&P. Now, I understand that the mega cap, 7 are up tremendously, but there's been a move, it's 8% roughly versus 5-ish for the S&P over the last month. And that's because investors believe that the Fed's done for now. I mean, done, I think, for the rest of the year.
Well, look, because